We have with us Nick Parsons of Thomas Lloyd joining in to discuss impact of US yields and as well the kind of roiling we are seeing in emerging markets. Thank you very much for joining us, Nick. This story of US rising yields, do you think they can continue to have a negative impact on emerging markets? Do you think smart money is simply, running away, fleeing emerging markets?
Well, good afternoon from London. I think the rise in US yields is going to continue to weigh on EM currencies. It's going to continue to weigh also on stock markets, because the only way it would seem at the moment that there's going to be any respite from this rising yield environment is if stock markets themselves take fright. So either we're going to see continued higher yields, which will pressure valuations, or we will see the equity markets preempting the potential for higher rates and falling of their own accord. So it really does seem as though it's going to be a very difficult few weeks in prospects for equity markets at a time which traditionally, the second half of October, is traditionally a time of heightened volatility.
Fair enough. Nick, so do you have a view on US interest rates themselves? I mean, this is effective tightening in the US as well, right?
Yeah. Well, yes, the monetary conditions index has become somewhat tighter in the United States, but if we look at the market pricing for the December FOMC meeting, it's still indicating an 83% probability of another hike at December 19, and a further 3 interest rate rises are priced in throughout the whole of next year. And so unless we see a significant correction in global equity markets, then those expectations for further rate hikes are going to pressure stock markets on valuation grounds. So it does seem at the moment as though there's no place to hide.
Oh, okay. No chance that looking at the fall in equity markets, the Fed may change its mind?
I think we'd have to see a substantial fall from current levels. If we look since President Trump was elected, at no point have we seen a daily correction more than 2%. And it's quite a long time since we saw equities going down to test even their 100 or 200-day moving averages. So I think from current levels on the S&P, we'd need to see another 50 or 60 points lower, and that in turn would translate into the Nifty being another 500 or 600 points lower than current levels before we start even to think about the Fed retreating from planned interest rate hikes. So I think the market is going to face a fairly troubled fortnight looking ahead.
And in the pecking order, emerging markets would be the last, and therefore they will see more selling even from current levels?
I think the great danger for emerging markets at the moment is what's happening in China. The rhetoric over the last few weeks had suggested that they were not going to use the currency as a weapon of monetary policy. Now, with the cut in the interest rates overnight, we're dangerously close to making a fresh all-time low for the Chinese renminbi. And if dollar renminbi prints at 7, and let's remind ourselves and your viewers that the previous all-time high was 6.95, we're trading as we speak at 6.92. If we break that high and if we start to print in the 7s, then that, I think, is going to pull the rug from under emerging markets as an asset class. So those hopes that we might just be finding some stability would be blown away if the Chinese currency were to trade to 7 against the US dollar.
Nick, oil could drop $7, $10, couldn't it?
Well, it's possible that oil falls and that helps stabilise inflation expectations. And of course, it was inflation expectations and worries about the current account deficit, which were two of the reasons generally held or generally offered for the fall in the rupee over the course of the last couple of months. But if we were to have a more generalised equity market sell-off around the world, and if China were to allow the renminbi to trade above 7, then I'm afraid that falling oil prices would only merit the 4th or 5th headline on your news programme. And so in that case, they're unlikely to offer a great deal of support if we're going to see a rise in volatility for all those reasons I just outlined.
Oh, how did you guess the order of our headlines? And you've guessed it right. But Nick, you know, the Indian Central Bank did not hike rates as other current account deficit central banks have done in the past month or so. Some rupee bulls were upset by that. But now looking at the way the Chinese PBOC has reacted, you think that it was just as well that the Indian Central Bank did not use the interest rate weapon?
It's a very good question. It was certainly a bold decision not to raise rates in a way which had generally been discounted by money markets locally. There are plenty of explanations in terms of the shadow banking system and in terms of worries that we've got in that sector, but I don't really feel that the Chinese move in and of itself vindicates the RBI's decision. It was a very high-risk strategy not to raise rates on Friday, and if they continue to show an apparent disregard for weakness in the exchange rate, it's something that they may still live to regret.
Oh.
Of course, if China's move is absorbed by the currency, then we're going to be okay. But I still think the RBI is playing a very high-stakes game here.
Okay, well, just one final question. Would you want to give us a guess for where the Nifty or the rupee may bottom?
The rupee seems to have 75 firmly in its sights, and quite a number of strategists have got that as a year-end target. I previously had warned that we could go to 72 or 73 even when we were trading in the 60s. I still think 75 looks a reasonable bet, and we'd have to see a considerable worsening of the outlook for EM globally if we're to go beyond 75 in a sustainable fashion. As far as the Nifty is concerned, well, 10,000 is looking vulnerable. We've already broken the 200-day moving average, and it wouldn't be an enormous surprise if we were to start to see the index with a 9 in front of it rather than a 10.
Okay. Well, tough times ahead. Thank you very much, Nick Parsons, for joining us and not mincing words. So anyway, 75 is not a long hop. 74.10 has already been seen on the screen.